Yesterday, April 27th, 2026, Intercontinental Exchange released the March 2026 ICE First. Look at mortgage delinquency, foreclosure, and prepayment data. The headline number that nobody covered with adequate analytical depth was this: active foreclosure inventory rose to 273,000 in March, the highest level in 6 years, and the largest foreclosure inventory since February 2020. That is 27% more properties in active foreclosure than were in the pipeline a year ago. Foreclosure starts are up 17% year over year. Foreclosure sales, meaning completed foreclosures, where the home was sold at auction, are up 21% year over year. 154,000 more borrowers are 90 or more days past due or in active foreclosure compared to the same time last year. And this data was collected through March 26, 2026, before the April consumer confidence reading hit 47.6, the lowest in 70 years. Before the FOMC meeting currently in progress confirmed that rates will stay at 3.5 to 3.75%. Before Thursday's triple GDP and PCE release. The IC data is telling you the story of what was already in motion before the most consequential economic week of 2026 arrived to add to it. And the story it is telling is being misread by almost every financial media organization covering it, because they are reporting each number in isolation rather than in the context of the mechanism that is driving them. The mechanism is the housing trap. And understanding the housing trap is the key to understanding both why 6.2% mortgage rates are not the relief the market expected them to be, and why the mass sell-off that is beginning in the data will not look like the dramatic crash of 2008, but will instead look like what the evidence actually shows. A slow, steady, geographically concentrated, demographically specific, economically driven liquidation of the marginal homeowner population in the most interest rate sensitive and insurance cost sensitive markets in the country. Not a crash, a drain. And the drain has been running for longer than most people realize. Let me give you the complete picture of where mortgage rates actually stand today, April 28th, 2026, because the 6.2% in the title of this video is not a forecast. It is the most recent official reading. The 30-year fixed-rate mortgage averaged 6.23% as of April 23rd, 2026, according to Freddie Mac's primary mortgage market survey released last Thursday. That was down from 6.30% the previous week. The current rate as of today, Monday, April 28th, according to Zillow's daily rate tracker, is 6.13%, the highest daily reading since April 14th. Freddie Mac described the current rate environment as representing the lowest level in the last 3 spring home buying seasons. It also noted that the lower rate environment has attracted a pickup in purchase applications and refinance activity, and that pending home sales increased in the most recent monthly data. On the surface, the data says the housing market is improving. Rates are at a 3-year spring low, applications are rising, pending sales are ticking up. The official narrative of the housing market in April 2026 is cautious optimism. The ICE foreclosure data published yesterday says something different. It says the official narrative is looking at the population of buyers who are successfully purchasing at 6.2% rates and ignoring the population of existing homeowners for whom the 6.2% rate environment, combined with the insurance cost cascade, the property tax escalation, the stagflation squeeze on household budgets, and the geographic concentration of economic stress, is producing the highest foreclosure inventory in 6 years. Both things are simultaneously true. The housing market for new buyers with stable incomes and strong credit is improving. The housing market for existing homeowners who are financially marginal, who bought at the top of the market in 2022 and 2023, who live in insurance crisis states, who have been squeezed by gasoline at $4.16 per gallon and groceries up 15% since 2020, is deteriorating. That dual reality is the housing trap. Let me show you the 4-stage pattern through which the housing trap converts rising mortgage rates and rising household costs into foreclosure waves, because the pattern is precise and its current stage is documentable in the IC data published yesterday. Stage 1 is the lock-in accumulation. This is the period during which interest rate increases cause a critical mass of homeowners to be unable to sell without dramatically worsening their housing cost. 82% of mortgaged homeowners still hold rates below 6%, according to Realtor. Com data as of November 2025. Approximately 40% hold rates at or below 3%. These homeowners cannot sell their existing homes and purchase equivalently sized homes at today's rates without increasing their monthly payment by $500 to $1,000. The lock-in effect traps them, not in financial distress necessarily, in their current homes. Stage 2 is the cost cascade. This is when the costs of maintaining the home they are locked into begin rising faster than the household income available to cover them. Insurance premiums are up 8.5% nationally in 2025, after an 18% increase in 2024. Property taxes increased approximately 12% across mortgage servicing portfolios over the past year. Gasoline at $4.16 per gallon is compressing discretionary household budgets in ways that affect mortgage payment priority. And credit card debt at 21% APR is consuming an estimated $120 to $150 per month of take-home pay for the 111 million Americans carrying revolving balances. The cost cascade is the mechanism that converts a trapped homeowner into a struggling homeowner. Stage 3 is the payment stress event. This is when a specific financial shock, a job loss, a medical expense, a significant insurance premium increase that pushes the total pity beyond the household's sustainable budget, converts a struggling homeowner into a delinquent one. The IC data published yesterday documented this stage with precision. The national delinquency rate declined seasonally in March to 3.35%, 14 basis points above last year. But serious delinquencies, meaning loans 90 or more days past due, continued to rise, with 154,000 more borrowers in that category than a year ago. The seasonal improvement in early-stage delinquencies is the housing market's normal March behavior. The continued buildup in late-stage delinquencies is the Stage 3 payment distress events converting into Stage 4 foreclosure filings. Stage 4 is the foreclosure cascade. This is the stage the IC data published yesterday confirms is underway. Active foreclosure inventory at 273,000, the highest since February 2020. Foreclosure starts up 17% year over year. Foreclosure sales up 21%. These are not the scale of 2008 to 2010. In February 2026, 38,840 properties had foreclosure filings, representing 0.26% of all housing units. At the 2010 peak, that rate was 2.23%, meaning today's foreclosure activity is 87% lower than the crisis peak. But the trend direction is unmistakable and accelerating. 12 consecutive months of rising foreclosure filings, the highest active foreclosure inventory in 6 years, and data that was collected before the most stagflationary consumer confidence reading in history confirmed that the economic pressure on marginal homeowners in 2026 is getting worse, not better. Let me prove this 4-stage pattern with 3 historical examples that show how the combination of elevated mortgage rates, insurance cost cascades, and household budget squeezes has historically produced the specific type of slow-drain foreclosure wave that the IC data is currently documenting. The first example is the 1980 to 1982 period, which is the closest historical analog to the current stagflation plus rate environment. Mortgage rates rose to 18% in 1981. Homeowners who had purchased at lower rates in the 1970s were locked in by the same mechanism that traps today's homeowners. They could not sell without dramatically increasing their cost of housing. Energy prices, which the Volcker-era rate hike cycle was designed to combat, were compressing household budgets simultaneously. The foreclosure wave that followed was not an overnight event. It was a 2 to 3 year drain of the most financially marginal homeowners in the regions most affected by the manufacturing recession that accompanied the rate shock. Regional banks in the Midwest failed as commercial real estate and residential foreclosure losses accumulated. The pattern was strikingly similar to what the ICE data is showing today. Early-stage delinquency improvement in the spring seasonal data, continued buildup in late-stage serious delinquency, and a foreclosure inventory that peaked well after the rate environment had begun to improve, because the mechanism converting delinquency into foreclosure takes 12 to 24 months from initial default to final foreclosure sale. Check, verified, undeniable. The second example is the 2007 through 2010 housing crisis, which everyone knows, but almost nobody correctly understands in the context of the current environment. The correct comparison is not between today's foreclosure rate and the 2010 peak rate. 50% of today's housing market participants make that comparison and conclude that current conditions are safe because today's activity is 87% below the 2010 level. The correct comparison is between today's trajectory and the 2006 trajectory, meaning the 12 to 18 months before the full crisis materialized. In 2006, foreclosure filings began rising on a year-over-year basis for the first time since the mid-1990s. The increases were concentrated in FHA and subprime loan pools. The increases were described by housing analysts as a normalization from historically low pandemic-era foreclosure levels, exactly the same language being used to describe today's increases. And the FHA delinquency rate, the leading indicator that historically precedes conventional mortgage stress by 6 to 9 quarters, was beginning its ascent toward the levels that would define the crisis. Today, the FHA delinquency rate is at 11.52%, the highest since the second quarter of 2021. 12 consecutive months of rising foreclosure filings are documented in the official data, and the ICE First Look published yesterday confirmed that the active foreclosure inventory is at its highest level in 6 years and continuing to rise. The difference between 2006 and today is not the direction of the trend. It is the scale, which is dramatically lower today because underwriting standards are dramatically better. The similarity is the trajectory. Rising, accelerating, geographically concentrated, FHA-led, cost cascade-driven, and positioned to convert more of the serious delinquency pipeline into foreclosure completions over the next 2 to 4 quarters. The third example is the post-pandemic insurance-driven foreclosure wave in Florida and Louisiana, which is the most directly applicable contemporary precedent for the mechanism currently operating in the states with the highest current foreclosure rates. Indiana has the highest foreclosure rate in the country as of early 2026. South Carolina, Florida, Delaware, and Illinois follow. In Florida and Louisiana, the insurance cost cascade has been the primary driver of mortgage stress for 3 years. The Federal Reserve Bank of Dallas published research confirming that in areas where insurance prices are rising due to climate-driven losses, there is a corresponding increase in mortgage payment delinquencies and defaults. The mechanism is mechanical. Insurance becomes unaffordable. Lenders force place coverage at even higher cost. The total pity exceeds the household's budget threshold. The household goes delinquent. The delinquency progresses to foreclosure. First Street Research projected that foreclosures across the United States could increase by 380% over the next 10 years due to climate-related insurance cost escalation. That long-term projection is being validated in real time by the short-term foreclosure data in the states most affected by the insurance crisis. This is the moment I want to stop and speak directly to you. If this analysis is connecting the ICE mortgage data published yesterday to the broader economic context of the most stagflationary spring in over 40 years, in a way that gives you a complete picture of what is happening in the housing market right now, this channel is built for exactly this purpose. Hit subscribe right now, turn on every notification. Because the ICE First Look was published yesterday afternoon with almost no analytical context in the mainstream financial media, and the 3 protective actions that prevent any homeowner from becoming a statistic in next month's ICE data are the subject of the final section of this video. Subscribe. Then let me give you the complete current data picture. Here is the specific data from the ICE First Look released yesterday that defines the scale and the trajectory of the housing market stress in April of 2026. The national delinquency rate was 3.35% in March, down 37 basis points from February due to normal seasonal improvement, but still 14 basis points above March 2025. That 14 basis point year-over-year increase is not the seasonal number, it is the structural deterioration number. The serious delinquency category, meaning borrowers 90 or more days past due, continues to trend higher. 154,000 more borrowers are in that category than a year ago. Active foreclosure inventory is 273,000, up from 213,000 a year ago, a 28% increase. That is the highest active foreclosure inventory since February 2020. Meaning the highest since before the pandemic forbearance programs that artificially suppressed foreclosure volumes for 2 years. Foreclosure starts are up 17% year over year. Foreclosure sales are up 21% year over year. Prepayment speeds, which measure early payoffs that occur when borrowers refinance or sell, rose 24 basis points in March to 1.06%, the highest in nearly 4 years. That prepayment surge is the positive signal in the data. At 6.2%, some borrowers who purchased or refinanced at higher rates in 2022 and 2023 are finding it cost-effective to refinance. Andy Walden, the head of mortgage and housing market research at ICE, described March as bringing the seasonal improvement typically expected, but with serious delinquencies, and the foreclosure pipeline continuing to rise. The dual signal, seasonal delinquency improvement plus continued buildup in late-stage stress, is the signature of a housing market that is holding at the surface while deteriorating underneath. The mortgage payment consumes over 30% of median household income today, compared to 21% pre-pandemic. The 30% threshold is the standard definition of housing cost burden used by HUD and housing researchers. A market where median payments consume 30% of median income does not have room for additional cost shocks. And the additional cost shocks are arriving. Gasoline at $4.16 per gallon. Insurance premiums up 8.5% in 2025 after 18% in 2024. Property tax reassessments reflecting 2021 and 2022 peak valuations in many jurisdictions. Credit card minimum payments consuming $120 to $150 of monthly household cash flow. Each of these individually is manageable. Simultaneously, for the most financially marginal homeowner population, they are the cost cascade that is converting Stage 2 struggling homeowners into Stage 3 delinquent ones. Here is the mass sell-off story that the title of this video describes, because it is not the dramatic crash narrative, and it is more insidious than the dramatic crash narrative because of precisely that difference. The mass sell-off is not concentrated in a single event. It is distributed across 12 consecutive months of rising foreclosure filings, a 21% year-over-year increase in foreclosure sales, and a 273,000 property active foreclosure inventory that represents the homes of 273,000 American households who are in the process of losing the most important financial asset they own. For each of those 273,000 households, the sell-off is catastrophic. For the markets where they are concentrated, the sell-off is visible in rising distressed property inventory, declining median prices in rate-sensitive price tiers, and the demographic hollowing of communities where insurance cost cascades and stagflation squeezes have been most severe. Indiana, South Carolina, Florida, Delaware, and Illinois, the 5 highest-rate foreclosure states, are experiencing localized versions of the sell-off that the national headline statistics are diluted by the national averaging that includes the California, New York, and Massachusetts markets, where strong price appreciation and wealthy demographics are insulating borrowers from the stress building in the Midwest and Southeast. The mass sell-off is real. It is documented in the ICE data, and it is being driven by the same combination of forces this channel has been documenting across every video in this series: the stagflation squeeze, the insurance cascade, the credit card debt spiral, the cost of energy at $4.16 per gallon, and a Federal Reserve that cannot cut rates to provide the relief that would break the housing trap. Until the trap breaks, the drain continues. The ICE First Look will document it every month, and this channel will analyze it every month with the depth you just heard. Subscribe right now. Turn on every notification. Share this with every homeowner you know who has not yet audited their PITI, called their servicer proactively, or reviewed their insurance coverage against the escalation that the annual renewal cycle has been quietly adding to their monthly costs. The housing trap is not a future risk. It is a current reality. And the ICE data published yesterday confirms exactly what this series has been documenting. The drain is running. Subscribe, and be here when next month's data confirms the direction. Let me give you the deeper layer on why 6.2% specifically is the rate that is triggering the sell-off, rather than a higher or lower rate, because the specific mechanism behind 6.2% as a threshold matters for understanding both the current dynamics and the trajectory. The conventional wisdom about mortgage rates and the housing market is that lower rates stimulate demand and higher rates suppress it. That framework is correct for the marginal buyer who is deciding whether to purchase at the current rate. But the housing trap works through a different mechanism for the existing homeowner population. For existing homeowners, the key threshold is not the current rate. It is the rate at which moving to an equivalently sized home becomes financially rational. For an owner who bought in 2019 at 3% and is now considering a job opportunity in another city, the relevant calculation is the after-tax monthly cost increase of selling at 3% and buying again at 6.2%. For a $300,000 mortgage balance, the monthly payment at 3% is $1,265. The monthly payment at 6.2% for the same balance is $1,844. That is $579 more per month, $6,948 per year, for a household that is also paying higher insurance premiums, higher property taxes, and gasoline at $4.16 per gallon. The 6.2% rate does not trigger a sell-off by making homes unaffordable for new buyers. It triggers a sell-off by making the cost of maintaining ownership financially untenable for homeowners who bought at the worst time, specifically the 2022 and 2023 vintage loans when rates were climbing rapidly and prices were near their peaks, who are now being squeezed by insurance and energy costs simultaneously, and who have negative equity or minimal equity from the price declines in the most rate-sensitive markets. The ICE data specifically documented that loans originated in 2022 and 2023 are performing the worst. These borrowers purchased at high prices with high rates and have experienced little to no appreciation that would give them an equity cushion. When their household cash flow is compressed by the cost cascade, they have no equity buffer to tap, no refinancing path that reduces their payment, and no sell and capture equity option that makes the financial pain of selling worthwhile. Their only exit paths are modification, deed in lieu, short sale, or foreclosure. And the ICE foreclosure sales data rising 21% year-over-year documents exactly how many of those exit paths are terminating at the foreclosure stage. The sell-off? The title of this video describes is the forced liquidation of the 2022 and 2023 vintage worst-case homeowners, concentrated in the states where insurance and energy cost cascades have been most severe, driven by the interaction between the mortgage payment burden and the total household cost structure that the stagflation environment has been building for 2 years. Subscribe right now, and be here every month as the ICE First Look data documents the progression. Here is the geographic distribution of the housing trap that makes the sell-off story not a uniform national phenomenon, but a concentrated regional one. Because the regional concentration is the key to understanding who is most at risk and which communities are experiencing the drain most acutely. Indiana leads the nation in foreclosure rates as of early 2026. This is not a state associated in the popular imagination with housing crises. It is not a high-price coastal market. It is a Midwest state with moderate home prices, moderate incomes, and a manufacturing economy that has been under secular pressure from automation and trade rebalancing for decades. The elevated foreclosure rate in Indiana reflects the specific combination of a homeowner population that is more financially marginal than coastal markets, an insurance cost escalation that has been quietly compressing pity across the Midwest, and an employment market that is more sensitive to the manufacturing weakness that the tariff environment has been producing. South Carolina follows Indiana. Florida is third. Florida's story is well documented in the insurance crisis context. Private insurers have been exiting Florida markets in large numbers since 2020. The homeowners left in the state-backed Citizens Property Insurance Program are paying rates that have increased dramatically. Force-placed insurance for homeowners who cannot maintain voluntary coverage is even more expensive. And the combination of insurance cost cascade plus the highest home prices in the state's history has produced the specific PITI expansion that the Dallas Fed research confirmed is directly correlated with mortgage delinquency increases. Delaware and Illinois round out the top 5. Delaware's story is related to the concentration of older vintage FHA loans in specific zip codes, where the pandemic-era forbearance programs masked delinquency that has since converted to foreclosure filings as the forbearance period ended and the payment shock of resuming full payments arrived simultaneously with the insurance and energy cost increases. Illinois reflects the combined pressure of a state budget environment that has been producing property tax increases in the Chicago metropolitan area, and the combination of an older housing stock requiring more maintenance with an insurance market that has been repricing risk in the Great Lakes region following several years of severe weather events. These are not random states. Each has a specific, documented mechanism driving its elevated foreclosure rate. And each of those mechanisms is one expression of the same underlying force. The housing trap, converting locked-in homeowners in stressed economic environments into the source of the highest active foreclosure inventory in 6 years. Subscribe every notification. And understand the geographic specificity of the housing trap before the data reports your community's trajectory. Let me close with the 3 specific protective actions that every homeowner can take today to protect themselves from becoming part of next month's ICE First Look data. Because this channel is not designed to document crises without providing the corresponding protective framework. The first protective action is the PITI audit and the cost of ownership recalculation. As I described in the Millions Will Lose Their Homes video in this series, PITI stands for principal, interest, taxes, and insurance combined, the true all-in monthly cost of ownership. Every homeowner should recalculate their true PITI right now in April 2026, not the number from their original mortgage application. Insurance premiums have risen. Property taxes may have been reassessed. HOA fees may have increased. The true PITI, for many homeowners, is materially higher than the number they hold in their mental model of their housing costs. Once you know the true PITI, the protective standard is a liquid emergency reserve equal to 6 months of that total figure in immediately accessible cash at a second institution, not in investment accounts that can lose value in a market correction, and not in home equity that requires a HELOC to access. The second protective action is the proactive servicer contact. As I documented in the Millions Will Lose Their Homes video, the time to contact your mortgage servicer about modification options and forbearance qualifications is before you miss a payment, not after. Banks that have filed to the ICE data with Stage 4 foreclosure inventory are simultaneously receiving thousands of calls from borrowers who are already in trouble. The borrowers who contact their servicer proactively before missing a payment while still current establish their standing in the modification pipeline at the point when the best terms are still available. After a missed payment, the options narrow dramatically. The third protective action is the insurance coverage audit and replacement research. As the insurance cost cascade is the most direct driver of the Florida and Southeast foreclosure elevation, every homeowner in a state where private insurers have been non-renewing policies should audit their current coverage, confirm that their carrier intends to renew, research the state fair plan's cost and coverage terms, and understand what force-placed insurance would cost if voluntary coverage became unavailable. The knowledge of what the worst-case insurance scenario costs is the information that allows a homeowner to decide whether to pre-position for that scenario now, through additional savings or insurance search activity, rather than discovering the cost when the non-renewal notice arrives with a 30-day response window. 3 protective actions: pity audit, proactive servicer contact. Insurance coverage review. Together, they address the 3 stages of the housing trap that the IC data published yesterday confirms are converting Stage 2 struggling homeowners into Stage 3 delinquent ones, and Stage 3 delinquent ones into Stage 4 foreclosure filings. The IC data is the scoreboard. The 3 actions are how you stay off it. Subscribe right now, turn on every notification, and share this video with every homeowner you know who has not yet taken these 3 steps, because the active foreclosure inventory is at its highest level in 6 years and rising. And the ICE First Look next month will either confirm the escalation or the first signs of stabilization. This channel will analyze both outcomes with the same depth you just heard. Subscribe and be here for both. Here is the broader economic context that makes the ICE First Look data from yesterday more alarming than the numbers themselves suggest in isolation. The ICE data covers through March 26th. What it does not capture is the economic shock that arrived in the final week of March and throughout April. The March CPI was released April 10th, showing 3.7% headline inflation. Consumer confidence dropped to 47.6 on April 11th, the lowest in 70 years of data. The Iran blockade was announced April 13th. Gasoline prices surged to $4.16 per gallon nationally in March. None of these events are in the ICE March data because the March data was collected before or just as they arrived. The April ICE First Look, which will be released in approximately 30 days, will be the first official mortgage performance data that captures how the March-April stagflation shock has affected household mortgage payment behavior. The directional implication is not ambiguous. Consumer confidence at 47.6 is the most direct behavioral signal available that households are pulling back on spending, including the discretionary spending they might otherwise deploy to cure a mortgage delinquency. The same households who are currently in the ICE's serious delinquency category, 154,000 more than a year ago, are the households most likely to have been adversely affected by gasoline at $4.16 per gallon, insurance premiums that have been rising for 3 consecutive years, and the combined pressure of record household debt at $18.8 trillion with 4.8% in some stage of delinquency. The April ICE data will show whether March's seasonal delinquency improvement extended into April or whether the March-April consumer shock reversed it. The probability, based on the historical relationship between consumer confidence readings in the mid to low 40s and subsequent mortgage delinquency changes, is that April's data will show a reversal of March's improvement. That probability is not a prediction of a housing market collapse. It is the informed analytical assessment of what the mechanism documented in every video in this series implies for the specific category of homeowner that the IC data has been tracking through the Stage 2, Stage 3, and Stage 4 progression. Subscribe, every notification. And be here in 30 days when the April ICE First Look provides the next confirmation of the housing trap's direction. One final dimension that belongs in this analysis because it is the most directly relevant to the title's use of the phrase mass sell-off, and that is what the term actually means in the current housing market context. A mass sell-off in housing does not look like a stock market crash. It does not happen in a single session. It does not produce a visible headline moment. It produces a specific pattern that the IC data is already documenting. Rising foreclosure filings every month for 12 consecutive months. Rising active foreclosure inventory that is now at its highest level in 6 years. Rising foreclosure sales that represent completed home ownership terminations at a rate 21% above the prior year. Each of those numbers represents a household, a family that owned a home and no longer does, a community that has one more vacant or distressed property, a neighborhood where the foreclosure sign in front of one house affects the appraisal value of every surrounding house. The mass sell-off is measured in the accumulation of those units, month by month, neighborhood by neighborhood, state by state. It is not the 2008 crisis. It is not a crash. It is a drain that has been running for 12 consecutive months, that accelerated in the first quarter of 2026, and that the stagflation shock of the Iran war, the insurance cost cascade, the credit card debt spiral, and the Federal Reserve's policy trap have all positioned to accelerate further through the second and third quarters of 2026. Understanding this as a drain rather than a crash is the key to understanding both its mechanism and its remedies. Drains are slower than crashes. They are also more insidious because they do not produce the shock event recognition that triggers policy response. They accumulate until they are undeniable. The IC data published yesterday is the most recent accumulation report. The active foreclosure inventory at 273,000 is the drain's current level. And the channel is here every month when the next report confirms how much higher that level has risen. Subscribe every notification, because the drain does not stop between ICE reports. It runs every day. This channel documents it every time the official data confirms another month of the housing trap's operation. Here is the final number that belongs at the end of this analysis, because it is the number that makes the housing trap story not just analytically important, but personally urgent to every homeowner who has been watching the housing market, and assuming that because home prices have not crashed, their equity is safe and their position is secure. 87%. Today's foreclosure activity is 87% below the 2010 peak. That number is the one the mainstream financial media uses to reassure homeowners that the current trajectory is not a crisis. And at the national level, that comparison is accurate. The current environment is not the 2008 to 2010 housing crisis. The underwriting quality is better. The equity cushions are larger for the majority of homeowners. The banking system's exposure to mortgage-backed securities is better regulated. But 87% lower than the 2010 peak means 13% is active. 13% of the worst housing market in American history is 273,000 households in active foreclosure. 13% of the 2010 peak is a number that was inconceivable as a measure of housing market health in any year between 2012 and 2022, when post-crisis reforms and pandemic forbearance had driven active foreclosure inventories to generationally low levels. 13% of the 2010 peak, rising, accelerating at its highest level in 6 years, and building its pipeline from an FHA delinquency rate at 11.52% that history says will convert to conventional mortgage stress within 2 to 4 quarters is not the reassurance the 87% comparison implies. It is the documentation of a housing trap that is catching more households every month in the most financially marginal segments of the market, in the most insurance-stressed states, and the most energy cost-sensitive communities. And it will not stop catching them until the rate environment changes, the insurance crisis is addressed, or the stagflation squeeze on household budgets is relieved by a combination of oil price decline, income growth, and debt reduction that no current data trajectory is delivering. Subscribe right now, turn on every notification, and share this with every homeowner you know who is making decisions about their mortgage, their insurance, their reserves, or their servicer relationship based on the 87% reassurance rather than the 12 consecutive month escalation that the ICE data documents. The housing trap does not care about the national average. It cares about your specific PD, your specific servicer relationship, and your specific insurance coverage. All three are actionable today. Subscribe, and be here for the April data in 30 days. And be here for the May data and the June data, because the housing trap does not take months off. It runs continuously, and this channel documents it continuously. Subscribe, every single notification. Because when 273,000 households are in active foreclosure at the highest level in 6 years, and 154,000 more are in the pipeline than were there a year ago, and 12 consecutive months of rising filings confirm the trajectory, the drain is not a maybe. It is a documented reality. And understanding it is the only thing that allows you to make the decisions that keep you out of it. Subscribe, and be ready for what the data says next month. The housing trap is open. The drain is running. The ICE data published yesterday confirmed both. This channel will confirm both again next month. Subscribe now, before the April data arrives and the drain is confirmed at a higher level than it was confirmed yesterday. Subscribe now. The housing trap does not wait, and neither should you. Subscribe, every notification. The drain is running, and this channel is here to document every drop.